Have you been turned down due to your FICO score? Are you looking to build your credit? Or you're wondering what their credit requirements are to purchase a home? Well, we'll be answering those questions and more in today's Lessons in Lending. In today's lesson, we'll be covering the basics of credit, how it works, how it impacts purchasing large items, and how it might affect what you pay as far as an interest rate. Let's dive right in. The first component the FICO algorithm is going to look at is your payment history. And let's cover what FICO means first. It stands for Fair Isaac Company, FICO. And it's an algorithm that's used when looking at what is being reported to each credit bureau. So the first criteria they're going to look at, that algorithm is going to examine, is your payment history. So it's only on payments that are reported to your credit bureau. If a creditor is not reporting to the credit bureaus, it will not impact your score at all, one way or another, either good or bad. However, your payment history, how you pay your credit cards, how you pay your car loan, how you pay your mortgage, all of that is kept on a monthly basis if that creditor is reporting to that bureau. The three credit bureaus, by the way, are Experian, TransUnion, and Equifax. Those three bureaus were set up in different locales in the nation. So initially, when FICO first came into existence in 1989, Experian used to be called TRW, by the way. It was in California. TransUnion was in the Midwest, and Equifax was located in Georgia. So initially, it was where that creditor was located as to what bureau it might report to. Now, most creditors report to all three bureaus. But regardless, they're going to report that history. That payment history is the most weighted of all the criteria that it looks at when developing that FICO score. The reason you have three different scores is those creditors report to different bureaus. Some report to all three, some report to two, some report to one, and some of your creditors don't report at all. So it's important to know which bureaus your creditor is reporting to or your creditors are reporting to. The second criteria we look at is the amount owed. Let me explain. It's not so much the amount owed, it's the amount owed as compared to the open line of credit. An example of this is if you had a $5,000 balance on a credit card and you had a $6,000 limit, it's going to look at that as overextended. You're going to look overextended as far as the FICO score when it's calculated. If that credit card has a $20,000 line of credit, it's not going to be an issue at all because as a percentage, you're only using 25% of that card's line of credit. So it depends on, the balance compared to the open line of credit. I'll give you an example how this impacts your score. I had a borrower purchasing a home. They had a $300 line of credit with Target. We pulled their credit. The score was fine. We're going to closing, but the credit expired during the process. About a week before the loan closed, we had a request from the underwriter to re-pull the credit, which we did, and the score dropped 40 points. We looked at everything. There were no late payments. Upon closer review, the balance on our Target card was $295 on a $300 line of credit. Well, the computer thinks that they're overextended and dropped the score by 40 points. So what we did was I contacted the borrower, the buyer of the home, and I said, this is what we need to do. You need to call Target and ask for a $2,000 line of credit. And she said, I can't do that. That's a lot of money. I said, trust me, you're going to need to get this score up or it's going to impact your ability to purchase this home. And it's just not going to happen unless we get that paid down quickly or you increase the line of credit as a percentage. Well, she called and they offered her a $1,000 line of credit, which was perfect because the computer's looking for 30% or less utilization of the credit. So with $295 owed on a $1,000 line of credit, she was below that 30% threshold. And her score jumped right back up, the 40 points we needed. So that's an example of how that type of thing works. This is a strategy we use quite often to help individuals qualify for a home loan and to get the maximum credit score. The next characteristic of the profile that's examined when calculating a FICO score is the length of time of established credit. So if you've just started establishing credit less than 12 months, it's going to impact your score because they don't have enough data to calculate your payment history or your willingness to pay debt. Every 12 months, you'll see an improvement as you build your credit. One other strategy that may work as well as authorized users, having your children on your credit cards is one way to help them establish credit where your credit history flows over to them. So it's one strategy to increase that length of history, which is 15% of your score. The next category is credit mix. This has been important, especially when purchasing a home. The computer wants to look at how you pay a similar debt. So it's going to look more at installment loans, large installment loans like expensive cars, that type of thing. How are you able to pay a high payment every month, and what's your history in doing so? That's going to be a critical marker on the credit. It's also obviously going to look at previous mortgages that you've had. That one improve your FICO score. So having a mortgage really helps in that mix. Revolving credit doesn't really have that much impact. They like to see 2 or 3 revolving cards, in other words, store cards like Target or Mervyn's, that type of thing. So those types of lines of credit, it's good to have 2 or 3 of those. What I find is the perfect mix is 1 mortgage, 1 or 2 car payments, and 3 or 4 revolving accounts. That seems to be the best mix. After looking at thousands of credit reports, that seems to equate to the highest score. The fifth component is new credit. One thing I want to warn people of when they're building credit is to start slowly, but start right away. Because when you establish a lot of new credit right away, that can actually impact your score because there's no history of payment. However, there's an incredible ability to go out and spend money that you don't have. And that's one thing that lenders are wary of because it's invitation to get in financial trouble and make payments that they're not used to making. So that's a concern of creditors. Again, the authorized users will want a way around that situation where you want to build credit, you want to do it quickly. That's a great solution. Another thing to think about when establishing new credit is and I've used this strategy for 25 years. If someone doesn't have any credit at all, I ask them to go to a Macy's or some type of department store, and they want to extend you credit if you're purchasing something. So I instruct them to buy a pair of slacks, a sweater, something like that, $40, $50, whatever, and not a lot of money, but bring it to the counter. And they always ask you if you'd like to open an account, right? And so say, yeah, I'd like to do that. And so you're at the counter, you're looking to purchase something. So you're a potential customer and say, I just want a credit line to put half of the value on it and I'll pay the other half cash. The likelihood of getting approved is extremely high if you do not have any established credit. And that's a great way to start the process of building credit and starting to look good to banks and lenders and eventually looking at a mortgage. The last criteria that's not technically in the mix, but it does impact your score is inquiries. Because I get this question all the time. Inquiries do impact your credit score. They can. There are soft inquiries, which are inquiries made by a creditor that you do business with that just wants to check your credit to see if you can be offered some type of special offer. That's a soft pull or a non-impactful situation. When you have a hard credit pull, it's when you're actively pursuing a loan from a creditor. Those do impact your score if you have many, many of them. So the rule of thumb is if you bracket them within a week or so, that requires one credit pull. What we recommend is if you're going to shop for a car, do it all within a week's time because they'll bracket those inquiries and it will count as one inquiry. The same is true with a mortgage. So we recommend, having, shopping in over a several day period, not multiple weeks. After that bracketed period of about 7 to 10 days, every inquiry starts to add up and it gets to the point where it does impact your score. As a mortgage broker, by the way, we pull your credit one time, we review it, and can shop to many different investors for your loan. That's how we do it. But other lenders don't necessarily do it that way. If you have questions about this, reach out to us or make a comment below and we'll get right back to you. But that's how the credit system works. If you found this information helpful, drop a like below. That helps us out. Again, my name is Brent Starts with Unitas Lending, and this has been your Lessons in Lending.